So a question I keep getting asked right now is, should I take my pension tax-free cash lump sum right now? The rumours are rife that Labour are planning to do something with pensions by the time their first budget comes around on the 30th of October 2024. We know they plan to raise taxes and they need money from somewhere to fill this so-called fiscal black hole. But could they really reduce or even remove the tax-free cash completely? If they do plan to do something with the pension tax-free cash, many of you might be thinking that you should take your tax-free cash lump sum right now before you lose the chance to take it. But is this a good idea? In this video, I'm going to go through the pros and cons of taking your pension tax-free cash lump sum right now. My name's Carl. Welcome to the channel. I'm a chartered and regulated and practicing financial advisor and also help run a fund management company. In these videos, I'm not giving advice, but just guidance and things for you to think about to help you build your own wealth and enjoy financial freedom. I cover topics such as financial planning, retirement planning, pensions, investments, and taxation. So we know Chancellor Rachel Reeves has come up with so-called £20 billion black hole, and that is going to mean taxes are going to have to raise. She's already ruled out raising taxes for income tax, VAT and national insurance. So that doesn't leave much else for her to gain significant funds. So therefore it does look likely that something is going to happen with pensions. So in terms of pensions, what could they do? Well, the first thing they could do is they could restrict and reduce the amount of tax relief that you get when you pay contributions into your pension. They could bring back the lifetime allowance, which is a cap effectively on the total amount you can hold in all your pensions before an excess tax charge is due. They could raise the minimum age that you can access your pension. This is particularly for your private or workplace pension. So currently the minimum pension age is 55, raising to 57. They could raise this higher to stop people being able to access their pensions. They could make pensions subject to inheritance tax, because currently there's very favourable death treatment for pensions where they don't necessarily get included in your estate on death. So they're a really good tool for planning for inheritance tax, which governments have said has not been their main purpose. And also, of course, they could reduce or even remove the tax-free lump sum. Now, focusing on that last point, the pension tax-free cash lump sum, or the pension commencement lump sum to give it its proper technical name, let's just remind ourselves of how this all works. So when you reach minimum pension age, which is currently 55 and is supposed to be changing to age 57, you'll have the opportunity to access and withdraw from your personal or workplace pension. Now, one of the options you have when you decide to make a withdrawal from an uncrystallised pension is to take a lump sum, tax-free, of up to 25% of the pension value. Now, you don't need to take this tax-free lump sum all in one go. You can phase it over a number of years. For example, say you have an uncrystallised pension, and when we say uncrystallised, it means you've never taken any withdrawals out of it before. So say your uncrystallised pension is worth £1 million. You could potentially take £40,000 a year out of this pension, and for every 40,000, 25% of the 40,000 would be tax-free. So £10,000 a year tax-free. The remaining £30,000 each time would be subject to income tax. Now, there is already a cap on the total amount of tax-free cash you can have over your lifetime from pensions, and this is now called the lump sum allowance. And the current cap is £268,275. You may be entitled to a higher lump sum allowance if you've had previous protections from having a higher pension value over previous lifetime allowances. So the easiest thing the government could do is to reduce this lump sum allowance cap, but that alone may not raise much tax for the government. If they were to reduce or remove the tax-free lump sum, this will actually cause a lot of problems for the government. For a start, it will get very complicated. Lots of retirees and people have taken money and tax-free cash out of their pension already, possibly for a phasing approach like we've just explained earlier. So some will have taken some tax-free cash and some will still have tax-free cash there to spend. There's going to need to be some sort of transitional protection put in place like there has been in the past for the lifetime allowance. Others will be very close to retirement and already planned or put in place a process to take their tax-free cash lump sum. So what's going to happen to these people? And it could also really wind up people in the public sector, because of course the public sector have very generous public sector pensions, and these also have the ability to take tax-free cash as well. So if you restrict that or remove it completely, it's going to cause a lot of problems in the public sector. It could mean a lot of doctors and nurses, again, bringing forward their retirement and taking their pensions early to avoid missing out on the tax-free lump sum. Something very similar to this happened previously under the Conservative government when new rules were brought in to reduce the amount you could contribute to pensions. This caused a lot of doctors and nurses to face very high tax bills, and many left the NHS altogether. It prompted a U-turn from the government, and the rules were relaxed to stop this from happening. So if the government do bring in a new rule and remove the pension tax-free lump sum, and they give people time to prepare for this, so for example, say they won't bring it in until the new tax year, this is going to cause a lot of people to start taking their tax-free lump sum out straight away, which is going to involve a big sell-off in the stock markets, particularly in the bond and gilt markets, which the government needs to access to loan from to help pay for all of its debt and spending. It could also lead to large numbers of people leaving the workforce early because they decide to take their pension earlier to make sure they get that tax-free lump sum, which again causes a problem in the labour market. So all in all, if the government is going to do something as radical as remove the pension tax-free lump sum, probably going to have to do it retrospectively and announce a rule change that would come into force midnight the night before. So some of you may be thinking, this all sounds very worrying. I'm just going to go ahead and take my pension tax-free cash lump sum because at least then I've got it. But let's look at the advantages and disadvantages of doing this. So the advantages of taking your pension tax-free cash lump sum right now in one go is that it's going to provide a significant boost, a cash boost to your bank account. And of course, you won't pay any tax on this 25% lump sum. This could be a really efficient way to release funds from your pension, particularly if you're a higher rate taxpayer, because the 25% is tax-free. If you can't take any of your money out of your pension tax-free and you're a higher rate taxpayer, you're going to be paying a lot of tax on your pension withdrawals. Having access to that pension lump sum may give you the opportunity to think about early retirement, because you may be able to live off that tax-free lump sum for a while, particularly if you're transitioning from full-time to part-time and then planning to retire altogether. Your tax-free lump sum could top up your reduced wages once you go part-time. And the fact that you're not paying tax on this lump sum means that actually you can earn a bit less because the net amount is still the same because you're paying less taxes. So giving yourself access to a one-off lump sum could help things like paying off the mortgage or helping make a gift to those children or grandchildren that you're planning to do. The key advantage here is that the tax-free lump sum gives you options. There are, however, a number of disadvantages if you do decide to take your tax-free cash now from your pension in one go. Remember, be very clear, there is no guarantee that the government will remove or reduce the pension tax-free lump sum. We're only working on rumours. So if you were to take your pension tax-free cash lump sum in one go now, and the government didn't make any changes, you would have lost the ability to have a bigger tax-free cash lump sum in the future. This is because the tax-free cash is a percentage. So if your pension pot grows over the next few years and into the future, you can take a 25% lump sum out of a bigger pot. Once you take your pension tax-free cash and you take it completely, you will never be able to take any further tax-free cash. All future withdrawals from your pension will be subject to income tax. So if you have taken your pension tax-free cash lump sum, but you don't actually have any spending plans for it, you don't actually need it, your next problem is going to be, where do you put it? What do you do with it? Where do you park it? If you leave it in a bank account, this is obviously going to start earning interest, and that interest is going to be subject to income tax, especially if it's outside an ISA or something like premium bonds. If you do keep it in cash, it's unlikely to keep its real value in real terms. Inflation is going to start eating away at the true power of this cash. Also, currently, pensions are free of inheritance tax in most scenarios. By taking the tax-free lump sum out and bringing it into your estate, you're then making it subject to inheritance tax going forward. So that could, in fact, actually be a large tax charge on this lump sum on your eventual death if you've not spent it. You could, of course, be losing access to greater retirement income in the future if you've taken out a bigger proportion of your pension pot right now. It means less money in the pot, less money to grow for the future, which also then means less chance of you being flexible for all those unknowns that might happen in the future. Ultimately, we just do not know what is going to happen at this stage. We can only make educated guesses. I would suggest that if you were always planning to take your pension tax-free lump sum and you have a clear plan on what you want to do with it, I would suggest you may want to take this sooner rather than later. However, if you don't need the pension tax-free lump sum right now, you have no plans for it, it will just end up sitting in cash if you did take it, I would suggest you leave it where it is in the pension and let's see how things play out. After all, this latest government's term might only be 5 years, we don't know. So if this current government does only last 5 years, then there'll be a new government in 5 years' time and it could all be changed again. I hope you found this video useful. If you have, please give it a like and don't forget to leave a comment with any questions or any feedback you have, because it could be really interesting and useful to other viewers of the video. And also, the main thing is, please don't forget to subscribe to the channel so you don't miss any videos that we've got coming up. Until next time, take care.